In this video we are going to talk about Start Investing 101. So before starting, please like this video and subscribe to this channel for our future updates. Investing allows you to put money aside while you are busy with life and have it work for you so you can reap the benefits later. Investing leads to a better outcome. Buffett defines investing as the process of putting money down today to get more later. Investing is the process of putting money to work in order to expand it over time. Assume you have $1,000 saved and are ready to go into the world of investing. Maybe you have $10 extra per week and want to start investing. This article will show you how to become an investor and optimize your earnings while minimizing your costs. What kind of investor are you? Before you invest, ask yourself, what kind of investor am I? Online brokers like Charles Schwab and Fidelity will ask you about your investment goals and risk tolerance when you register an account. Some investors actively manage their money's growth, while others prefer to set it and forget it. You can invest in stocks, bonds, ETFs, index funds and mutual funds with more conventional internet brokers. Number 1. Online brokers. Full service or cheap brokers. Full-service brokers provide standard brokerage services as well as financial counseling on retirement, healthcare, and other matters. They typically exclusively work with high-net-worth customers and charge a percentage of transactions, a percentage of funds managed, and sometimes a yearly membership fee. Full-service brokerages typically require at least a $25,000 account. Traditional brokers defend their hefty costs by providing specific recommendations. Discount brokers were once rare, but now they're common. Many discount internet brokers also offer a set-it-and-forget-it robo-advisory service. Online brokers have introduced more capabilities to their sites and mobile apps as the financial services industry has evolved in the 21st century. While some cheap brokers do not require a minimum deposit, there may be additional restrictions, and non-deposit accounts are subject to certain fees. If you wish to invest in stocks, you need consider this. Number 2. Robo-advisors. Betterment's John Stein and Eli Broverman are widely acknowledged as the pioneers in the field. Their goal was to employ technology to reduce investment expenses and streamline financial advice for investors. Other robo-first companies have sprung up since Betterment's inception, and even major online brokers like Charles Schwab have introduced robo-like advisory services. By 2025, 58% of Americans say they would employ robo-advice, according to a survey by Charles Schwab. 3. A robo-advisor may be right for you if you want an algorithm to make financial choices for you, including tax loss harvesting and rebalancing. 4. And, as the success of index investing has demonstrated, if your goal is to develop long-term wealth, a robo-advisor may be a better option. Number 3. Investing through your employer. If you're on a limited budget, put 1% of your salary towards your company's retirement plan. The truth is, a donation of that magnitude is unlikely to be noticed. Work-based retirement plan contributions are withdrawn from your salary before taxes are calculated, making the payment even easier. If you're happy with a 1% contribution, you can gradually increase it when you obtain annual raises. The extra contributions are unlikely to go overlooked. If you have a 401k plan at work, you may already be investing in your future with mutual fund allocations and even stock in your own company. Number 4. Minimums to open an account. A minimum deposit is required by many financial organizations. In other words, unless you deposit a specific amount of money, they will not accept your account application. Some companies won't even let you open an account with a deposit of $1,000. Before determining where you want to open an account, do some research and read our broker evaluations. Some companies may not have a minimum deposit requirement. Others will frequently reduce costs, such as trading and account administration fees, if your balance exceeds a specific threshold. Others may provide you a specific number of commission-free deals just for signing up. Number 4. Commissions and fees. There is no such thing as a free lunch, as economists like to say. Despite the fact that many brokers have recently raced to reduce or eliminate trading commissions, and ETFs provide index investing to everyone who can trade with a bare-bones brokerage account, all brokers must make money from their customers in some way. In most circumstances, your broker will charge you a commission every time you purchase or sell stock. Trading commissions start at $2 per trade and can go up to $10 for some bargain brokers. Some brokers do not charge any trade commissions, but they compensate in other ways. Brokerage services are not provided by any charity organizations. These costs can mount up quickly and have an impact on your profitability depending on how frequently you trade. Stock investing can be expensive if you jump in and out of positions frequently, especially if you just have a limited amount of money to invest. A trade is in order to buy or sell shares in a single firm. If you want to buy 5 different stocks at once, this is considered 5 separate deals, and you will be paid separately for each one. Let's say you decide to invest $1,000 in the stocks of those 5 companies. To do so, you'll have to pay $50 in trading fees, if the amount is $10, which is 5% of your $1,000. After trading expenses, your account would be reduced to $950 if you invested the entire $1,000. This equates to a 5% loss before your investments have even begun to earn. If you sell these 5 stocks, you'll have to pay the trade expenses again, which will be another $50. It would cost you $100 to make the round trip, buying and selling, on these 5 stocks, or 10% of your $1,000 initial deposit. You have lost money simply by entering and departing positions if your investments do not generate enough to cover this. Number 5. Mutual fund loads. There are other charges involved with this sort of investment, in addition to the trading fee for purchasing a mutual fund. Mutual funds are professionally managed pools of investor funds that invest in a certain area of the market, such as large-cap U.S. stocks. When investing in mutual funds, an investor will be charged a variety of fees. The Management Expense Ratio, MER, which is charged by the management team each year depending on the number of assets in the fund, is one of the most essential fees to consider. The Yearly Management Expense Ratio, MER, varies depending on the type of fund and ranges from 0.05% to 0.7%. However, the larger the MER, the greater the impact on the fund's total performance. When purchasing mutual funds, you may encounter a number of sales costs known as loads. Some are front-end loads, but no-load and back-end load funds are also available. Before you acquire a fund, be sure you understand whether it has a sales load. If you wish to avoid these fees, look for no-load and no-transaction fee funds on your broker's list. When opposed to stock commissions, mutual fund fees are really an advantage for new investors. This is because the costs are the same regardless of how much money you invest. As a result, you can invest as little as $50 or $100 per month in a mutual fund if you meet the minimal account opening requirements. Dollar cost averaging, DCA, is a moniker for this strategy, and it might be a wonderful way to get started investing. Diversify and reduce risks. In the world of investing, diversification is thought to be the only free lunch. In a word, diversifying your assets reduces the chance of a single investment's poor performance negatively impacting your overall investment return. It's a financial jargon way of saying don't put all your eggs in one basket. When it comes to diversity, it will be most difficult to achieve through stock investing. The costs of investing in a high number of equities, as previously said, may be detrimental to the portfolio. It's very impossible to create a well-diversified portfolio with a $1,000 deposit, so be aware that you may only need to invest in 1 or 2 firms, at most, in the beginning. This will put you at greater danger. This is when the primary advantage of mutual funds or exchange-traded funds, ETFs, becomes apparent. Both types of securities typically contain a large number of equities and other investments, making them more diversified than a single stock. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.